All right. Good morning, everyone. It is 7:40 in the morning of August 18th, 2022, and this is my pre-market strategy session. So, what I have here on the page is a view of the SPY, which is a proxy for the S&P 500. And I don't have anything on this chart right now except for yesterday's close and this morning's pre-market price here. I will add, a couple more things here to it here in just a moment. Essentially, though, this is what we have, right? We have this 6-month period, roughly. Let's see. So here's the peak, and here's where we are now. So between January and August, so roughly an 8-month period. There between, let me make these lines a little bit bigger in case they're hard to see for anybody watching on their phone. About an 8-month period between here and here. Now the down period, I think, is probably, let's say, go from start to finish, from peak to trough there. Yeah, it's about a 6-month period there from peak to trough for the down move. So we had about 6 months of bearish activity on the market. Now today's video is titled Inflation Reduction Act. And the reason that I usually don't really comment too much on politics, I have commented on politics on this channel a few times before, but usually I tend to stay away from politics because it's all kind of a bunch of BS anyway. But there are some things that will affect the trajectory of the market. Now, I remember, I had just started trading in 2006. And I started an MBA program in 2000. I started studying for the GMAT in 2006, and I started an MBA program in 2007. And it was quite an exciting time to be an MBA in finance student, a student with, going for an MBA in finance. At the same time that the financial crisis of 2007 kicked off in 2007, as soon as that kicked off, I was in school, and so I remember. Actually, let's go back. I believe it's March 14th, 2007. So let's go to the Wayback Machine here. 2017. March 14th, 2009. Sorry, not 2007. I think it was March 14th. March 6th. March 9th. So I think it was the 6th or the 9th. I think it was the 9th. And on the 9th, that's the day that the Troubled Asset Relief Program was announced. The Fed had already dropped its rates to 0 prior to the Troubled Asset Relief Program being signed. And it's back here, March 9th, 2009. Yeah. Here, let's go. Let's see. Let's do some Googling here. Troubled Asset Relief Program. Let's see, when was it signed? When was the program signed? Oh, October 3rd, 2008. Okay. To prevent the situation from completely spiraling out of control, Treasury Secretary Henry Paulson pioneered the Troubled Asset Relief Program. It was signed into law in October 3rd, 2008, with the passage of the Emergency Economic Stabilization Act. Huh. Okay. Well, anyway, like I was saying, there's something. I know that it was, maybe this is when the first money was spent. Maybe that's what it was. But I remember, oh, jeez, Well, before I do a video, I'll have to do my homework before I do the video next time. Well, okay. So it was signed back here. Back here. Here's October 9th of 2008. Here's October 10, 2008. And the market drifted downward a little bit further. I think this is when the first. I think Google's wrong. I think Google's wrong about that. But anyway, I'll have to go back and look at that again. But okay, anyway. What we have here, the Reflation Reduction Act, is really, it's more stimulus, and it's stimulus for certain industries. So what is tech gonna do? All right. Well, the SPY, the S&P, is out of bear territory. You know, it's now from its peak, it's only down. I think it's less than 12% now. Let's see. Let's put a. Let me change this to the weekly. Make it a little bit easier to see. So here's the very top right here, and here's where we are right now. And there's been between let's see, January and here in August, there's been it's down 11%. All right, and so that is definitely out of bear market territory. From peak to trough, it was down 25%. There's so many people warning right now about this being a long and extended bear market. Well, if it is, let's look at a couple things here. So this first trend line that I'm going to put in, this is sort of a bottom right here, or I'm sorry, not a bottom, but a support and resistance line. And I really prefer support and resistance lines that are more flat than angled. And it's because they tend to be more reliable, in my opinion, in my experience. The support and resistance lines that are much more horizontal than they are angled in any degree or fashion tend to be more reliable. So here we have it, breaking up above this support and resistance line here recently. Now, for it to come down and sort of retest this area a little bit and then bounce away would be just a very healthy move. The forecast, all of the economic forecasts are saying it's still bearish. Earnings are coming down. Layoffs are coming down the pipe. There's, a lot more negativity for the market. Well, okay, just trade the chart that's in front of you. So let's take look at a couple of more things here. Here's this resistance line. So here we are, we're at it, and it came up, and actually, if you look at this, there's a little tiny tail candle right here, topping tail candle right here on the 16th. Gosh, was that Tuesday? Yeah, it must have been Tuesday. Yeah, it's 16th. And poked through it and then closed back below it. So, okay, is this just a short-term thing? Comes down for a pullback. Look at this. This is a beautiful chart. If you don't look back here, but here's a pullback, run up, pullback, run up, sort of a pullback, then a run up, and now are we just due for another pullback and then another run up? That would be perfectly normal market behavior. Is the bear market over, or is this just going to suck investors in, and then perform the next gigantic leg down? It's really tough to say. I would, so on a daily basis, I kind of wipe all of that clean, figure out what my bias for the day is, and either fade my bias, which is I act in a manner that's contrarian to my bias, or I act congruently with my bias. but at least I have a decision, at least I have something to trade against or with, right? So right now I'm bearish, right? And so that means when these things on the 1 minute and the 10 minute start going into overbought, I'll fade that move and look for opportunities to short, even if it's just only a matter of a 10-minute trade. And I will be waiting a little bit longer until I'm willing to be bullish. So yeah, that's the way it is. All right, so here are the cues. Now, and here's why I don't like the angle of these, this breakout right here. And the reason that I don't like this breakout is because, okay, if it comes back and it tests, it has a successful retest, it has to make it back above this price of 329 roughly, right? In order to kick the next leg higher off. A bounce off of this support and resistance line isn't really something that's, a long term, it's not, something that I can ride for 2 weeks, which are the really profitable trades, the ones that, if suppose for a moment I'd bought the breakout right here, which I didn't, unfortunately, when it broke through this price resistance right here at 296 and then ran up, 307. That was only a 3-day move until it, came back and tested. But then after that, it put in a real nice move. And I didn't catch, because I had a bearish bias, I didn't catch this move at all. I didn't profit on that move at all. And so, I've been sitting on my hands a lot for the past 2 months now. So what happens now? It's really tough to say, and I think it's just the time to kind of sit back and wait and watch. A failure here on the cues definitely means the lows are going to start getting taken out, and then the failure on the SPY. I mean, we're right at the resistance on the SPY. Means another sort of drifting down. Long term could last another 6 months, like it did starting in January of 2022 so far. Here we are, January of 2022, and there's a 6-month time period. Are we starting another 6-month time period of downward movement with these really sort of these violent moves up? Are only things you see in a bear market. Unless you go back here, and this is where the trillions of dollars in stimulus was passed. This is COVID. These violent moves up only happen after bear markets. So the bias is to the downside, but I am also taking profits quickly if I take a trade even. So all right, the VIX is working on, if we can get the VIX to quiet down and stay down below 20, below 19, and really get this thing to start drifting down, the bull market is going to just be outrageous. As soon as the VIX really starts to settle down and start to put in lows again in the 15s and so forth, that's when it's just time to start putting money to work on the long side period. Just look for, buy the dip every which way you can. Another interesting thing is Bitcoin here. So Bitcoin has put in a head and shoulders reversal pattern here, and this is the neckline on Bitcoin. It came up, popped up above it, and in my experience, the neckline on a head and shoulders reversal pattern is really quite reliable. There can be, let's look, I think I still have BABA. I think I still have my scribblings on BABA here. Let's take a look at BABA. This is a head and shoulders pattern. Yeah, there it is right there. This is a line that I put in probably, I think it was, 2 years ago. So here's the here's the neckline on the Head and Shoulders from Baba from 2 years ago. Now, with Baba, I traded Baba on the short side, and I did make decent money on it. Just the only thing that really kind of crimped my earnings is that there was a deregulation of Chinese companies, or I'm sorry, delisting of Chinese companies was being touted by the administration at the time, and I've forgotten what it was, but essentially I had to get out of the short because if the news came out that it was being delisted, then I wouldn't be able to be short it anymore because it would then be delisted, so I'd be out. And if it came out that it wasn't being delisted, then it would run up high. And so the news came out that it wasn't being delisted. I didn't capture, so the move that I captured was after it came back up to retest, so it broke down below the neckline really violently. I wasn't in a short right here. You have to wait until it breaks the neckline to really get the first move down after the break of the neckline. And so it plunged through that, right? And so I was like, okay, well, there's that gigantic breakdown that, is supposed to happen on the break of a neckline on a Head and Shoulders pattern, but I'm not in it, So it came back up and retested the neckline right here, and this is where I shorted it. And I did manage to capture the majority of this move down, this 7% move down right here. I got a majority of that 7% move. And it was leveraged, so it was nice, and then I left it alone because it was like, oh, we're going to delist Baba, and so that meant that if Baba got delisted, I'd be out of the trade. I wouldn't be able to profit on the trade, and then so the news was good for Baba in both directions as far as price action was concerned, because everybody that was in it had to hold tight until it was decided whether it was delisted or not. And if you're trading to the downside, it was a lose-lose situation. So I had to get out of it because it was either going to be delisted and I wouldn't be able to profit on the trade, or good news was going to come out and it wasn't going to be delisted and I wasn't going to be profitable on the trade. So, but in any case, here's the neckline on Baba, and you can see here that it did come up significantly higher than the neckline here. I think this is a bit of a special case, but this peak over here, this peak right over here, never got as high as the right hand shoulder. So it's a proper Head and Shoulders reversal pattern. This is the way up and then the way down. The neckline is pointing to the way down. There are a lot of people who will do Head and Shoulders, but they're not doing them correctly. And the criteria for a Head and Shoulders is that the trend, general trend on the way up, or the general trend into the Head and Shoulders, is the way up. This is for a bearish reversal, and then the neckline has to point in the opposite direction of the trend. So you'll see a lot of Head and Shoulders patterns that people are putting on. There's a guy, gosh, what's his name? John Howell. I think he's Australian. He's an Aussie, and he doesn't do his Head and Shoulders correctly. I've commented on his channel a couple times about the proper Head and Shoulders, and he just, I don't know, just keeps doing his Head and Shoulders wrong. But anyway, so here we have a proper Head and Shoulders on Bitcoin. Here's the neckline. In my opinion, this is bearish, and it continues to be bearish for quite some time. I think actually I have it being bearish for something like 3 years, possibly. I think it's going to be a long time before Bitcoin starts to run with the bulls again. I think 3 years is a minimum. So yeah, not looking good. All right, here's the 10-year, 2-year spread. It's negative. The pink line you see here in the middle of the chart is 0. And let's see how many weeks we've been inverted, how many weeks we've stayed inverted here on this thing. So let's see. We'll call that one 1 week. So 1, 2, 3, 4, 5, 6, 7 weeks. And the yield curve can stay inverted for a year and a year and a half. The examples that we have here in 2007 and in 2001, this is the dot-com bubble, and then this is the housing bubble. I believe this one stayed, the 2001 curve stayed inverted for a year, and then the housing bubble stayed inverted for about a year and a half. And it's not until, and the reason I point this out is that it's not until the yield curve starts to normalize that the stock market takes a dump. So over here in today, it's, you know, this can continue. This can continue for quite some time before the stock market reacts to the yield curve normalizing. So I know it sounds really weird. I'm looking for bearish setups to trade, but the market could be quite bullish all the way through this. The market could remain, in an uptrend. The market could go up for a significant amount of time, even while economic conditions are worsening. So, again, my bias is to the downside, but I will be taking profits quickly. And if we start breaking back down into the 15s or so, then I imagine that there's going to be some sort of just insane blow off top, some kind of just insane like run past all-time highs between the next 6 to 12 months on the S&P that are that really just blows this top away. I don't know that's going to happen. It's really quite possible that this could be the start of the next big leg down. I just have to wait and watch. So let's see this next. Here's the support line right here. Oops, I'm gonna keep the support line up. So here's where support is. So, if we break support, this flat line support, I'll be looking for it to at least hit this line right here and bounce off. Short term bearish. Long term, no idea. 6 months, what the market's going to do, I have absolutely no idea. The case, there's plenty to be said for negative returns on the S&P for extended period of time, with the way global economic conditions are stacking up. However, that doesn't mean that's what the market's going to do. So just sit tight. Just trade the chart that's in front of you if you're a trader. And right now I'm focusing more on, I'm talking like 10-minute to 1 hour trades, and then at some point in time I'll start looking for the 2-week to 3-month swing trades for the bigger profits. All right, everybody, good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. I am out.